Welcome to Certified Credit's Talk Data to Me podcast, where our FCRA certified experts help you tackle the latest regulations, emerging trends, and unique challenges of the mortgage industry with an intuitive, people-first approach. And of course, data. Because your business is built on more than just a score. Visit certifiedcredit.com for more information. Certified Credit helps you hone your best practices from lead generation to post-closing QC and everything in between.
This is Elizabeth Langburton of Certified Credit's Talk Data to Me podcast, and joining me today is Scott Fink and Ben Hoen of Weltman, Weinberg Reis. How are you guys doing today?
Great, Elizabeth. Thanks so much for having us.
Absolutely. Thank you for being here. And
Glad to be here.
Thanks for inviting me to your office. We're here at their office in downtown Pittsburgh. You guys have a couple offices throughout the region, don't you?
Yeah, we sure do. In fact, we've got offices in Philadelphia as well as Pittsburgh and Pennsylvania. We've got offices in Ohio and Cleveland, Columbus and Cincinnati, Michigan and Detroit, Chicago and Illinois.
You're all over the place.
Yeah, we cover a good portion of the Midwest Great Lakes region, don't we?
Very cool. And so today we're talking about a topic that I think a lot of us are a little bit nervous about in the mortgage industry, which is delinquencies, foreclosure, forbearance, and really what we're seeing in those trends and how that's going to be impacted. So I'll turn it over to you guys. Let's just start with what are you guys, seeing as professionals? What is your background? What have you been experiencing here at Weltman?
Sure. I'll start.
Go ahead.
I've been with Weltman for 18 years now. I'm a shareholder and the chair of the real estate default group. My specialty is foreclosure and title litigation. I've been doing that since 2004. So we've been representing mortgage lenders, mortgage servicers, all throughout different times during the financial pendulum swing, so to speak, where we've seen everything from the crisis back in 2007, and then as that went away, and we moved into the COVID era, and now we're moving out of the COVID era, and it's a very unique time, I think, in our industry, and the pendulum once again is swinging, and we'll get to talking about all of that.
Right. We have a little bit of a volatile market right now.
Yeah.
So, and Scott, tell us a little bit about yourself.
So I head up the firm's bankruptcy practice. I'm with the firm now for 18 years or so. Been in the industry for about 25. Our practice is really wide ranging. We do represent mortgage servicers and lenders, commercial, consumer, bankruptcy, strictly from the creditor side, auto loans, credit cards, student loans. We've got our hands in a lot of areas, and we, like everyone else, we've seen both sides of the equation at this point, where bankruptcies were booming, and we've seen where bankruptcies during and as a result of COVID were really at record low. So we're rebuilding up from a point of you had to go back to the 80s to find a level when bankruptcy filings were that low, and the first quarter of this year is certainly trending upwards, and we'll sort of get into that.
Okay, absolutely. So I think that's a really good jumping off point for us here. And let's go back in time a little bit. Let's start with 2009 and that mortgage crisis. Do you feel that there are any lessons that we learned in that 2009 mortgage crisis that would be beneficial for today?
Yeah. In fact, I think there's a lot that we learned from that crisis. Going back to 2009 and the passage and promulgation of the Dodd-Frank Act, we learned a lot because lenders were doing things in a way that caused loans to go into default. And that's kind of what caused the foreclosure crisis at the onset of the housing crash.
Okay.
They were lending at 125% loan to value. They were lending to low credit borrowers. They were putting people in mortgages that they shouldn't have. And to that end, the government stepped in and said, we've got to pull the reins back, and they passed the Dodd-Frank Act. And that kind of set the pavement for an era where we could get out of the foreclosure crisis, because lending practices became more streamlined. They became more responsible.
Yeah, there's more regulation in place today.
More regulation, which, is a good thing. But I think what we're seeing now coming out of COVID. So what happened when we went into COVID? We were at record lows as far as mortgage defaults. The economy was just humming along. And then COVID hits and the bottom falls out. There's the shutdown. The government pretty much kills a good portion of the economy. People have become instantly unemployed and everything is kind of in limbo. Are people going to be able to pay their mortgages? How are we going to proceed? And the government says, okay, we've got a problem kind of caused by the government, but that's another discussion. Now we've got to find a solution. The solution was we're going to put a foreclosure moratorium out and we're going to institute COVID forbearances, which essentially told the servicers the borrowers don't have to pay if they have a hardship. And it was very easy to apply for these forbearances. You basically had to call your lender and say, I have a hardship due to COVID, and you were in. Whereas previously, during the post-Dodd-Frank era, the loss mitigation process was very, it was intense. Borrowers had to submit pages and pages of documents, and it could take months before they would get reviewed for a loss mitigation plan. And if they could qualify, the communication wasn't the greatest. And I think what we learned from that era and what the government is trying to resolve now is, okay, let's short track it. Let's give people the benefit of the doubt. The lending, because of the post-Dodd-Frank era, lending practices were tightened, and therefore the people who are in these mortgages belong in the mortgages. There's that assumption, and therefore if they've suffered a hardship, they should be put into a forbearance plan. And that worked. It was phenomenal. You had millions of people who had suffered hardships were then put into forbearance plans. But the COVID emergency is coming to an end. In fact, the president announced that the COVID emergency will be ending in May. So that kind of left everybody in limbo. Okay, so what happens now?
Yeah, that's what I was going to ask. We know that you have this residual effect. There are people who were using those programs, even if it wasn't necessarily a hardship caused by COVID. And so we know that there was regulation released recently that talked about, we're going to extend that 6-month period. So how do you guys see the residual effects of this credit utilization for the forbearance agreement impacting today, tomorrow, and mortgage lending in the future, and primarily mortgage, not even on the lending term, but when we look at housing as a long-term wealth gainer for your families, for it's a home. Like at the end of the day, we're looking at homes. People live there, and so how do you see all of this culminating right now?
Yeah, the Assistant Secretary of HUD recently released a letter that said, we are now going to extend the COVID forbearances to any borrower who is facing a hardship, whether it's because of loss of employment or another hardship. So it really opened the door for the mortgage servicing industry to have that tool back in their shed, where we thought come May, that tool was going to be gone. So that's a good thing for mortgage servicers, because they're going to be able to keep their borrowers out of foreclosure. But as we discussed in our last session, we've been seeing record consumer debt. So there's a lot at play here, and I think that really ties in to where are we headed in the bankruptcy realm? How is that going to affect foreclosures going forward? Because we've just been seeing consumer debt skyrocket like it's never done before.
So Scott, what are you guys seeing? In your vision?
So I'm going to add to what Ben said a little bit, and maybe say it a little differently, and that is, I think what happened in 2008 fundamentally changed the way that lenders and servicers deal with their borrowers on the mortgage side. That was such a shock to the system. I think the lesson that was learned is we can never end up in this situation again. And if you pull that forward to COVID and beyond, and this was happening long before COVID, the knee-jerk reaction that said, if a borrower is, pick it, 60 days, 90 days in default, we're foreclosing. I think those days are over. I think that the banks, I don't want to say learn their lesson, because it's just, it's a fundamental change to how the business model.
Right.
And the forbearance agreement and a loan modification program is always going to be the first and the second and the third option now. I think nobody wants to initiate a foreclosure if there's another way. So
it's an expensive process.
it's an expensive and lengthy process. And I think what history has now shown is there's maybe a better way, at least from the bank's standpoint and for the larger economy. So COVID certainly reinforced that and allowed them to use some of the tools and the lessons that were, learned along the way. And it allowed us to get through what could have been a very, very turbulent time. Foreclosure levels, went to the floor, as did bankruptcies. And you see this interplay of bankruptcy is the result of a lot of other things in the economy, foreclosure being just one of them, as to why somebody chooses to file a bankruptcy. They file because they're imminently going to lose their home in a sheriff's sale. But they lose their homes because they go through a divorce, or excuse me, they file bankruptcy because they are filing a divorce, because they have medical debt, because their credit cards have gotten out of control, because they've lost their job. There's a number of factors that lead to it, but we're talking about mortgages today, so foreclosure being one that, as we see the foreclosure rates start to tick up, which we are seeing. I mean, I was surprised. I was surprised to see the jump up of, I think it's something like 36% increase in foreclosure filings in January, and then another 18% on top of that when you compare January to January of the prior year. Some pretty significant jumps, and we're seeing that on the bankruptcy side, where we saw a 5 to 10% bump January to January, February the same kind of thing, in March. We saw the largest increase in quite a while in March in overall bankruptcy filings.
I'm sure that isn't helped, and I'd be interested to see what comes out this month based off of what we've seen over the last 2 to 3 months with the bank emergencies and everything that's been happening in Silicon Valley and the impact and that job loss. Because we all know that the last thing you stop paying on is your home. And with the rising consumer debt and that filing of bankruptcy that's happening and the continuing of this systematic issue, I'm really interested to see what those numbers bring. So you brought up an interesting point there about the interplay between foreclosures and bankruptcy. And really, what does that relationship look like?
So again, one of the many reasons someone would seek protection under the bankruptcy code is to stop or halt a foreclosure. The federal bankruptcy code gives specific powers that halt all collection activities, pending lawsuits like a foreclosure or sheriff's sale, in their tracks using the automatic stay. And typically, if someone is truly trying to save their home through a bankruptcy, they're going to opt for what's called a Chapter 13 bankruptcy, which is more of a reorganization. Gives them breathing room, gives them 60 months, up to 60 months, and arguably a little bit more right now, coming off of some COVID tweaks to the bankruptcy code, but essentially 5 years to catch up on your mortgage arrears and stay current on your payments going forward. And from where I sit and what we do with our clients, we will have to review the plan of reorganization, make sure that the lender is being treated fairly, meaning, are they going to be able to afford to cure the arrears? Are they providing for the monthly payment? Are they trying to do what's called a cram down for any reason and strip off a mortgage or pay less than is owed? But really, that's truly the interplay. Is the foreclosure is stopped in its tracks, and the bankruptcy allows for breathing room for someone to get caught up on those arrears. And if they are successful in the bankruptcy, at the end of the 5 years, they should be current on their mortgage, and they should have cured those arrears, and they can emerge, and the foreclosure is essentially done. That's
Well, so I'm thinking about this from the perspective of a consumer. How successful is that Chapter 13 bankruptcy usually?
So the rule of thumb, and I will admit I haven't seen it in the last several months, but the rule of thumb was about a 30% success rate. So
Okay, better.
3
than
out of
nothing.
every 10 will make it all the way. 7 out of every 10 will not,
Okay.
and will end up right back where they started in a dismissed case, and the foreclosure will restart.
Okay.
So there's some hope, but it's, you know, if you were playing baseball,
Yeah.
300's a pretty good average, but for a bankruptcy success rate, maybe
Right.
not.
Right. Well, and I think that's brings us to an interesting point of, I don't think a lot of lenders and I don't think a lot of consumers understand how that process works. So could you walk us through that loan mitigation process and in that foreclosure process and how it's going to impact that consumer and impact that lender?
Do you want to take the?
Yeah, absolutely. So, and to Scott's point, we're seeing a rise in bankruptcies. However, as we alluded to earlier,
Right.
with this new HUD guideline on loss mitigation and instituting the COVID waterfall for all debtors,
Right.
that might have an impact on how many foreclosure-related bankruptcies are started in the next
Okay.
18 months. So the reg extended the COVID protections
Right.
to all borrowers for the next 18 months through October of 2024.
Okay.
I'm going to show my age. I'm going to help Ben.
Not having
36% increase in foreclosure filings January of 23 versus 22, 18% in February, 45% increase in completed foreclosures.
So a lot of those
Huge difference there.
That is
there
a
is
huge
that's comparing the
Prior February.
pre-moratorium
Right.
expiration to the post-moratorium
Right.
expiration.
Okay.
And that was anticipated. You had a lot of bottlenecked loans in there,
Mhm.
loans that should have gone to foreclosure but couldn't because of the foreclosure moratorium. And that's why we
Gotcha.
saw a huge spike
Right.
in January and February following the lifting of the moratorium. I think things have, started to stagger off a bit. I don't have
Mhm.
the exact numbers, but just judging from, the numbers that I'm
Right.
seeing across my desk, you're seeing some, stabilizing of the foreclosure market. And I think
Gotcha.
that's because lenders are utilizing those loss mitigation tools.
Okay.
Many foreclosures that are started are not completed because these loss mitigation tools are in effect.
Right.
Now, given that this 18-month period,
I was going to say it's only 18 months.
Well,
So
we thought it was going to end in
will
May.
it be extended? We don't know.
We don't know. And then, it's funny. This kind of reminds me of the old joke that when do you start getting worried? It's when when somebody comes to your door and says, "We're here from the government. We're here to help."
Right.
So the government is helping the borrowers, but at
Right.
what expense? It could be a short-term fix creating long-term consequences. And why do I say that? Going back to the lessons we learned in the foreclosure crisis in
Uh-huh.
08, 09, and all the practices we changed, we're seeing some of those aspects show up in the loss mitigation process now.
Gotcha.
So the HUD guidelines say we're now going to, and one of the loss mitigation programs is allowing a borrower to reinstate their loan. It's called a partial claim if they can make the payment every month. But what happens to the arrearages? The arrearages get put on either the back of the loan or a second mortgage, actually,
Okay.
where they capitalize on an interest-free loan, all of the arrearages. Previously, it was up to 25% of
Wow.
the loan principal balance.
Okay.
Now you can go 30% under the new guidelines.
Okay.
So we're talking about borrowers that are now going to have upwards of 100%
Right.
loan to value on their properties.
Right.
Now,
Is there is there PMI attached to that?
so that's another interesting point because there is PMI attached to that. However, the HUD secretary has just recently stated that they're going to reduce the amount of PMI that borrowers have to pay in order to help them get into these forbearances. Because one of the ways to get out of the forbearance after that period is over is to modify the loan. Well, now with rising interest rates, it's
Right.
very difficult to modify a loan because the loan payments are going to go up, not
Right.
down. And the purpose of the modification is to try to get somebody
Mhm.
into an affordable payment. So with reducing those PMI payments, it kind of offsets some of the
Rising interest
the costs from the rising interest rates. Now, I mean, we're getting circular now because
Right.
what caused the rising interest rates?
Right. And
You
well,
know?
the thing I'm thinking about here is, when we're talking about that 100% loan to value,
Mhm.
That's concerning.
that's very concerning,
Very
especially because some of these homes might have already been appraised at more
Correct.
than they were worth. So we're looking at a pretty high loan to value. We're looking at inaffordability, and
Right.
how does this play out in the long run?
Yes. So that's one of the things we learned from the last go round.
Right.
I mean, you put people into these situations, yeah, it might be a short-term fix.
Right.
Maybe we keep people out of foreclosure in the short term, but is that going to put more people in foreclosure in the long term?
And what did we used to think before 2008? Housing prices can never go down.
Exactly. I mean, and we're kind of on that spectrum now.
They got up very artificially high during COVID, and they're starting to trend down again. It's still, they're still very healthy, but if you start talking about taking people up to 100% loan to value, these are the things that caused problems in the past, and it makes me a little uneasy that we're getting back there.
There was an economist who spoke at a conference I was at recently, and she was talking about it before the pandemic. And we're looking, out west in California. Before the pandemic, the average income to, home price, mortgage rate, your cost of housing was roughly about 50%. So people were spending about 50% on housing. Out in California right now, they're up to about 87%.
Right. It's
now we're
just
fortunate
impossible.
here in this region, it went from like 19% to 22% in Pittsburgh.
I think I was always told like 30%, you get beyond that, you should start getting concerned.
Yeah, that was the loan modification.
If 50%, whoa.
Right, so like what are we going to see in the long run is where I'm concerned, and I think a lot of us are.
And that ties into what we're seeing on the consumer credit side too. People are exhausting all of their available credit options, and then they're not going to have equity in their house.
I'm going to give you real numbers again to help you here. On the consumer credit side, they rose nationally by more than 15% in 2022. Household debt levels exceeded $16.6 billion in the third quarter of last year. That's the fastest pace in 15 years.
Wow.
So it's real. They're real numbers, and it's happening.
It goes beyond right now. We're talking about housing affordability. It goes to inflation. It goes to that lifestyle inflation. I mean, when you have the stimulus checks coming in, think about I don't want to say frivolous, because a lot of people did need the money that was coming in from those relief payments, but those who necessarily didn't might have been putting them towards things that they had wanted.
Right. And you get used to living at that level.
Right.
Which I'm gonna throw a curveball here, and maybe I'm getting ahead of myself, but I know this is primarily talking about mortgages, but from the bankruptcy side, something we are watching very closely is what's going to happen to the student loan, the forgiveness / repayment moratorium, which is how this started with a repayment moratorium.
Pushed down to September now.
Well, end of June is currently where we're sitting, and it's either 60 days after the end of June or 60 days after the Supreme Court rules on the student loan forgiveness, whichever happens first.
I think that's interesting because I got an email that said September.
Well, they may have some lenders that are making their own decisions. Either way, what we've got now is a situation where people, like with the stimulus payments, have gotten used to a certain
income.
It's not even income, a reality, a financial reality that says, maybe I had a $700 monthly payment for my student loans, or $1,000, or who knows, or a couple hundred. And that's been off the table for a lot of people, millions of people. It's one thing when you do it for a few months because we thought COVID was, people were going to be on the streets and without jobs and all that. And did it for all the right reasons. But after you do it for a few months, and then a few more months, and a few more months, it's not just, people don't just get used to it, they expect it. And now we are beyond 3 years of this. Good luck turning it around and saying, by the way, you've got to start making that payment again. People's budgets they filled that hole with something else. And if that forgiveness doesn't happen and the moratorium stops and people suddenly have to start making the payments, there's a lot of ifs here. We are concerned that bankruptcies are going to spike because people are just going to, they're going to be without a net. It's kind of like, what do we do? the budget doesn't work anymore, and you're going to see some more bankruptcies than you thought.
Right. Well, and we're talking about mortgage, I know, but on that student debt side, doesn't most student loans not actually go away with bankruptcy?
So that is true. Then that has been a debate that has been going on for a long time to say, should we change the bankruptcy code and allow for student loan debt to be more